In today's video, we're going to discuss how I outperform the markets on down days using Defiance, Yieldmax, and Cornerstone funds, even when being in around $300,000 of margin debt. And that margin debt helps us earn over $200,000 per year in dividends at this channel and live the FIRE lifestyle, which means financially independent, retire early. If you want to live free from a 9-to-5, email me for my e-guides at akentod48@gmail.com. So we're outperforming on a daily basis, and we're also outperforming on a year-to-date basis. We're up 17.75 year-to-date, whereas the S&P is up 9, the Nasdaq's up 8, the Dow's up 3, and the Russell's up 2. So again, we're up 17.75%, and we're beating all the indexes even when we're in over $200,000 of margin debt here, okay? It's $250,000 of debt, but when you include my sold options that I have, okay, the premiums that I receive from those, this number is really closer to $300,000. So you would think with all of this margin leverage that I use that, again, I would be down huge today, but I'm actually staying in line with the indexes, okay? And I'll share with you 5 reasons how I do this in today's video. If you want to follow my portfolio, just click the join button on my wall at YouTube, or I'll link that in the description below. So the first point I want you to consider is that my dividends pay back all of my losses, okay? That's how I outperformed in 2022 during the bear market. We had losses obviously in a given day, but if you collect dividends of around $240,000 per year, well then whatever days gains you lose, you'd have to have many days of being down $8,000 just to break even with your dividends. So that's how I outperform in a given year using margin leverage, because my dividends pay back my losses. But the other reason why we outperformed in 2022 was because of our special drip in Cornerstone, okay? Cornerstone, it's a 4-star fund, and yes, I'm talking about Cornerstone, but it's how I outperform on a given down day and in a given year, okay? Because as you can see here, Cornerstone is not down as much as the indexes, all right? It's down 0.7% when the S&P is down 1.14, the Nasdaq's down 1.07, and the Dow's down 1.29. But on up days, you've seen Cornerstone outperforming the indexes. That's because Cornerstone is just special, but it has a 21% dividend that it drips down at the NAV every month for free money. So if you're in a down market, well, if you're dollar cost averaging at the bottom, like Cornerstone allows you to do, well, then you're always going to get ahead, okay? So I don't know why everyone hates Cornerstone, okay? It's a 4-star fund once again, and I guess they look at the chart and they say, well, it goes down over time, Todd. Why would you be in this kind of fund? Well, you have to factor back in the dividends and drips and the rights offerings, okay? And look, you can see it moves up. It moves better than the market in a given up year, but if you time it around its rights offerings, that's how you capitalize and make all of your money, okay? And that's what my Volume 4 e-guide is all about. And we have an RSS feed here in the Discord chat room hooked up, thanks to Gaines, one of my admin, so that we can get that rights offering announcement from Cornerstone. We also have almost 1,000 members here in the Discord chat room pursuing the FIRE lifestyle, who can most likely answer any questions you may have on your brokerage account, okay? Because not every brokerage is the same. Not every brokerage has the special drip for Cornerstone. And I think that's why I get so much hate for Cornerstone, is because investors can't either get the special drip or they're at Robinhood, so they can't even buy Cornerstone, okay? I think that's where the hatred is coming from, okay? And if you're just looking at the chart and you don't like that, again, factor back in dividends and drips. But anyway, that's how I outperform. Dividends help pay back losses. That's the first reason. And also Cornerstone has a special drip, so it dollar cost averages at the bottom for me. So that's the second way that I outperform. The third way that I outperform is because I buy low beta names that move down less than the market on down days. So if I stay heavily weighted in low beta names like Cornerstone, okay, closed-end funds, especially like Cornerstone, GOF, GOF. GOF is also a 4 to 5-star fund on Morningstar. These are lower beta funds that usually move down less than the market. You can see GOF is down 1.15. It's down less than the Dow Jones at least, but I don't have a lot of my money concentrated in GOF because it's not fully indexed like Cornerstone is. That's why I put so much money in Cornerstone, is because it's indexed and it has 30% maintenance. So GOF has 30% maintenance and it's somewhat indexed, but it also has other kinds of fixed income. But Cornerstone is mostly indexed, and I trust the indexes more than bonds or fixed income or small caps, because when interest rates rise from inflation heating up like we got today, then you see small caps and bonds get hit the hardest. All right, so Cornerstone, it's indexed. That's why I put so much of my money in it, and it's also 30% maintenance. So that's how you live the FIRE lifestyle, is you keep low maintenance names that help you keep high available withdrawal. These help me pay my bills and withstand over 20% corrections in the market. My dividends of over $200,000 per year will pay back my debt in around 1 year, here. And then also it helps pay my bill. I don't mind holding this debt because it's low interest debt. It's around 6% interest. I negotiated it down twice. Many of my clients who bought my e-guides did the same thing. So I don't mind having this margin leverage on. It doesn't show up on credit checks to banks, but the dividends that they help me provide do show up as qualifying income to banks. So that's how I live the FIRE lifestyle, is I use the dividends from my margin leverage to not only pay back my margin leverage, but to qualify for loans to banks, okay? Because they won't take trading gains, they won't take Bitcoin gains. So when we're up 7,000 on a given day, which you've been seeing recently in all my videos, you've been seeing that we've been up consistently 5,000 a day, 7,000 a day, 10,000 a day, whatever it is. You've been seeing exorbitant gains all coming from Cornerstone. Well, those don't show up as qualifying income to banks for loans. Those are just icing on the cake and help us get more performance and more available withdrawal, which gives us more cushion from a margin call and helps us withdraw freely from our account whenever we want to. So obviously when you have big up days, you can go spend and splurge a little bit out of your account. I never do because I'm disciplined and I want to get ahead in this life. So I'm saving all my money, all of my dividends, everything goes back towards paying my debt down. Okay. I don't have to have it down. I just want to grow. Okay. I just want to grow with the least amount of risk as possible. And the more you can grow your equity, all right, this number here, by getting more days gains, okay, the more you can live your FIRE lifestyle comfortably without the risk. And the way we get these days gains is from our index exposure, and they move up on up days, but on down days, as you can see, we're down less than the market. And that's also because of funds like QQQY. These are our Defiance ETFs. QQQY is the NASDAQ ETF, and it has a 65% dividend. So obviously if you hold this fund for more than 2 years, then you're completely paid back and it's all free money after that. Free cash flow, paying monthly dividends for life, acting as a paycheck, paying qualifying income to banks for loans. Do I get paid by Cornerstone or Defiance or Yieldmax for promoting their products? No, okay? I just believe in them because they help me live the FIRE lifestyle. So view margin maintenance requirement though, 50%. That's the problem with Defiance funds, QQQY, and even Yieldmax funds, okay? They are high maintenance, okay? And Cornerstone is low maintenance, and that's how I live the FIRE lifestyle. If you need help understanding maintenance, that's in my volume 3 e-guide. So QQQY, IWMY, you can see that they're outperforming. Look, QQQY was down 0.63. IWMY, it's down 2%. The Russell itself was down 2.44%. See that? The Russell's down 2.69. As you can see there, IWMY is down 2.9. So that's outperforming. QQQY, it's down 0.63, but QQQ is down 1%, over 1%. So this is how we're outperforming on down days. And on up days, Defiance doesn't move up as much as the markets, but that's why we have Cornerstone in place. Cornerstone helps us get those gains on up days. And again, you have to time Cornerstone around its rights offerings, and that's in my Volume 4 e-guide. So Cornerstone gives us our growth. Yieldmax also gives us some growth, but it's 50% maintenance, okay? 50%. Also, the stocks that I own in Yieldmax, I keep them small, and that's how I outperform. The fourth point that I wanted to share with you today on how I outperform the markets on down days, even when being in $300,000 approximately of margin debt, is I just have position size management of my triple leverage ETFs. If you follow my portfolio like my members do, you'll see that I own some triple leverage ETFs, but I keep those position sizes small, okay? 5 to 10,000 in UPRO and TQQQ, you've seen in my past videos, can make you $1 million, but they can only lose you 5 to 10,000 in a given year. So I keep my triple leverage exposure small, and I keep most of my money in Cornerstone and Defiance in return, okay? So my triple leverage ETFs, they give me a little bit of juice on up days and help me outperform in up markets, and they could potentially make me millions of dollars over the long term, but they can only lose me a small amount of money. I also keep shorts on with my triples, okay, to offset the longs just in case we have a down market. They act as a glorified strangle if you're familiar with options, okay? So I'll have 5 to 10,000 in a long and 1 to 2,000 in the short. This is how I mitigate losses. I also keep insurance on at all times, put option insurance on at all times. I'm not worried about having option protection because my dividends will pay back my margin debt in around 1 year, but just in case. My last point number 5, I sell options to get more premiums and lower my margin, okay? So this margin debt of around 250,000, it's really around 280,000 or so because of all the options that I sell, but I sell leaps because they not only lower my cost basis. Okay, the large premiums that I receive here, let's say take an IEP for example, $60 strike price, I receive $4,300 in premiums. Well, that lowers my cost basis to below $20. So that's lower than the current market price. That's how I not only lower my risk by selling put options and pay down my margin debt by selling put options in these leaps. But these leaps, as you can see here, they move small in a given day because leap options move smaller than regular options since they're further out. So that's how I minimize my volatility in my portfolio with these sold options. I do the leaps, and that way they move less on down days. If you sell upfront options, then you have to sell a lot more to matter, and that sucks up all of your equity. I sell options for the year. It doesn't suck up as much equity. It pays down my margin debt, and they move small because they are leap. Remember, when you buy my e-guides, you get free access to Discord for life, where we alert you of the Cornerstone rights offering announcement, and also you get my phone number for life, so just keep that in mind. And if you want to follow my portfolio to see how I allocate my positions to outperform on down days, just click the join button on my wall at YouTube, or I'll link that in the description below, and I'll talk to you soon. Thanks.